Good morning, everybody. Happy Thursday. Happy end of November. Can you believe it? Welcome to the morning show. Spencer, we got JC, we got Steve. Ari Wald is today's featured guest. Very excited to have him on the show from Oppenheimer. We'll have him at 9. We'll have Sean, Option Sean, join us at 9:30. So you know what to do. If you're watching us on YouTube, hit that thumbs up for me, please. It really does help. It genuinely does, and I do appreciate it. And then I guess without further ado, let's just start the show. Let's bring the guys on.
Oh, what a wonderful day. It's like a holiday for me, Strazza.
Yeah, why is that?
New monthly charts at the end of the day. Very exciting. I it almost brings a tear to my eye, Strazza.
Makes you cry? Monthly charts make you cry?
It's just so much, it's just like tears of joy and happiness and peace. It brings me home. It's so easy to get caught up in the what did the Dow do today or the Powell, right? Like all these things and the GDP and the farm payrolls and all this stuff, right? Isn't it nice to just put on some music and then just go through the monthly data? It forces you to identify the direction of primary trends. Fortunately for investors, we know for a fact that asset prices trend. So identifying the direction of those trends can be very helpful in our daily endeavor to profit from the market. How do you feel about that, Spencer?
It's one of the best exercises.
I think for you, it's as comforting as the sun rising and setting for the rest of us, right? It's a reminder that life goes on.
It is a beautiful thing. Monthly candles, underrated, guys, underrated. If you're not taking the 5, 10, 15 minutes, in me, it takes a little longer. I'm a little OCD, but for normal people, take the time, go through the charts, identify the direction of those trends. If you're not doing it, you're doing yourself a disservice. You're doing your family a disservice. You're doing a disservice against humanity. By the way, I don't know if anybody has bothered to count.
We're counting again? Are we doing more counting today?
We never stopped counting.
All right. What are we counting today?
The world's most important stock market index is up 3,000 points in the last month.
Semiconductors aren't up that much.
What an asshole you are.
Hey-o.
I thought it was software. Now it's semiconductors. Depends on what the futures are doing. Is that how it works around here?
No. Software, best stocks. Semiconductors, most important stocks.
All right, you ready for this? Month to date. So I'm not cherry picking like the lows or anything like that. It's just this month. Very simple. Month ain't over yet, by the way. Dow futures up 200 points. Month ain't over yet. TLT up over 11%. QQQ up over 11% as well. Russell 2000 small cap index up 9% for the month of November. S&P 500 almost 9%. The global index, the global 100 up 8.5%. EFA up 8.3%. Mid caps up 7.8%. And emerging markets, the big underperformer, up only 7.5% so far for the month of November. I was promised a crash, Strazza.
No crash.
These guys are fucking assholes with their credit events and their credit crisis and their yield curve inversions. Like the amount of trolling that I received that last weekend of October because we were making it blatantly obvious that we were buying stocks very aggressively. The amount of trolling I was getting, and not that I have time to keep receipts or anything like that. It's more of like a lesson. Like let's be aware of our surroundings and being aware of where sentiment is and where we are in those sentiment cycles. There were people who sold into the hole because they were listening to the angry guy on Twitter talking about Black Monday or whatever.
Yeah.
So
You got your feelings hurt a little bit there around Halloween. Right?
Me?
Yeah.
I didn't get my feelings hurt. I love Halloween. What do you mean?
On the Twitter.
Oh,
Yeah.
I'm good. I've been around for a while, Strazza. I've hung out plenty in dugouts and locker rooms and trading floors. You know, these pansies, you know, sexy pants 69. You know, I've heard worse. I got a great I don't want to steal the thunder. I have a hilarious recess for later. Hilarious that I can't wait to share with you. Speaking of pansies.
All right.
Yeah,
Well,
read out the unemployment claim data.
Are they still doing that?
I think so. I think they still do it. I mean, they're just counting, right? They're just counting.
Are they counting really though?
I mean, I haven't paid attention to initial jobless claims really since like June 2020.
I want to know what the farm payrolls are. That's everybody just ignores the farm payrolls. I don't know why. Whatever. Why are the farm payrolls not important?
Because we're an industrial economy, JC. We don't have.
I don't think so.
So PCE coming in lighter than anticipated.
Yeah,
I don't know what that is. Can you hit the bumper?
No, it wasn't.
Month over month, right? Expecting 0.1, actual flat.
I'm seeing all in line, but yeah. Anyway, okay, we'll hit the bumper.
Core was in line.
Please. All right.
So real quick, because we should be doing this stuff here.
Yeah, go for it.
Claims. Actual was 218. We were expecting 220, so really a nothing burger. Continued claims 1.927, expecting 1.87. Personal income in line. Personal spending more or less in line.
Dude, personal spending is like, you know, the other day I asked Callie Cox what like the next boogeyman is going to be. It seems like a lot of people are harping on this personal spending, right? And how, it's all credit card debt. The consumer can't keep it up. It's gonna collapse. You just wait till the holiday season really kicks into high gear. Black Friday was a mirage. I don't know. I'm just seeing every day I see more and more about that.
The thing about credit card debt is that it's always going to be making new record highs, right?
You're right.
And it should be. If it wasn't, that'd be a problem.
Right. Yes.
So you need some sort of denominator there when you analyze that data. And a lot of times people who like scary charts or even chart porn won't put a denominator in this, and they'll just show you this crazy credit card spending growth chart.
Yeah.
It's really not that scary.
Yeah. Counting numbers always go up because that's how math works. So anyway,
I don't know.
Okay.
Why don't we start with slide 2 here to show how this is just this month alone. New monthly candles tonight. We'll have that final data. Dow futures up 225 points, completely ignoring whatever number just came out. S&P futures up 33 basis points, about 15 points. NASDAQ 100 futures up 30 basis points. Bond futures flat, gold flat, silver flat, copper flat. Oil up over 1% this morning, and the dollar inching higher. And that's the big one for me. What's going to cause some sort of correction during a seasonally weak period, which is that early December period, traditionally not as strong as November or the back half of December. That seasonal strength comes in the back half. So some weakness at the index level over the next couple of weeks would actually be perfectly normal. So we'll see what happens. But just wanted to show that chart of the October gains. Bonds and stocks both moving very aggressively together. Throw that slide 3. This is a big one, guys, because, you know, for the last 20 years, we've been talking about stocks and bonds. This is something I want to talk to Ari Wald about. By the way, shout out Ari Wald. Big fan of Ari. One of my favorite technicians out there. We're super fortunate to have him as a guest today, or anytime that he comes on our stuff. Bonds and stocks moving together. Not something that we've been accustomed to seeing over the last 20 years when it was more of a deflationary concern. Historically, when inflation is the concern, these two start to move together. So my suspicion is that it's going to take investors, a lot of investors, a long time to adapt to this new environment. And again, my suspicion is that the worst investors are going to take the longest to adapt. How do you feel about my theory?
Yeah, probably. I think that just in the case of bonds right now, like the past few days or this week, has been big. Right? Taking out those 2022 highs. Not too many people talking about this, but the dollar tailwind came off and the dollar fell back into its range. Now yields are falling back into their range. But
how long do you think that this can last? Stocks and bonds moving together?
Indefinitely?
Decade plus? Decades?
Sure. Why not?
I don't have a reason why not.
Depends on the inflationary regime that we're in.
What about all these 60-40 portfolios that are now just 100 portfolios?
I don't worry about that. Like that's
no.
That problem has never been my problem. I think that's crazy. And I don't know many people who actually do that. To be honest.
Lazy financial advisors do it to their clients who are bad at math. But I'm not saying that you have to be concerned about it. I know that you're not dumb enough to do something like that. But there is that 60 portfolio contingent that is going to have to be unwound, is really my point. So I'm thinking about the implications of the unwinding and how long something like that is going to take. Again, I don't have answers. I'm thinking about what that's going to look like. You know what I mean? Like, what are the implications of an unwind?
Okay, so that would put upward pressure on yields, is what you're saying. I think it
does it.
Well, you're saying there's going to be a lot of bond sellers, right?
Bond sellers because bonds are moving up?
No, you're saying
stocks?
No, people closing out 60-40 portfolios. They are forced sellers of bonds, right? I think the supply and demand dynamic, especially for treasuries, is so much bigger where the treasury now, because it's doing all these auctions, right, and is putting a ton of supply on the market of new treasuries, I think that's really kind of the bigger supply and demand thing to pay attention to, is the supply at all these auctions, right? That was big signal last month.
I guess I just don't understand the way that these auctions are impacting the day-to-day movements of the markets. I guess I've never been able to kind of wrap my head around that. It's kind of like equity flows, and outflows. Like I can't wrap my head around how to use that to my advantage, you know?
Yeah, but the auction sets the yield that day, right? So the news will be, oh, there weren't enough buyers. Treasury, issued all these new treasuries and the 30-year, fell to whatever.
Yeah. All right. You say so. This is the big one for me here, slide 4. This is it, right? Have we beat it to death enough, or should we just continue to pound the table because people aren't listening? Both?
I think we've beat this horse to death.
And then how come people keep trying to fight me on it? Like it's not happening. Like, no, JC, but in the 90s, the dollar, right? Like why is it so hard for investors to wrap their head around just how strong this negative correlation has been, continues to be, and all of the data coming in not only doesn't invalidate it, it actually suggests that the correlations have never been stronger. Right? Why is it so hard for investors to wrap their head around this? Why are they so worried about these stupid payrolls or what the Powell said yesterday? Or, why are they focused on the things that don't matter instead of focusing on the things that mathematically have proven to matter the most? Why do you think that is?
Tradable events.
That's why you think it is, because like catalysts, like a Powell speech is more.
Yeah, It's what Anne Marie always says. Like we trade it because it's there. It's not there because we trade. She doesn't say it quite like that, but her point is like the event is there, so we trade it, so we interpret it because it's there. Because you know, haven't you ever like been at a party and you find yourself just like whether it's like food or drink and you're just like consuming and you're like, oh, just because it's here, right? Like, do I want it? I don't know, it's here.
You only do that at parties?
I was gonna say, geez, I
All right, fine.
I go to Stu Leonard's for the free samples.
All right. Like, did I want that? I don't know. Doesn't matter. It was there.
Should we also be in this same conversation showing an overlay chart of the 10-year and I don't know, ARC or pick your speculative growthy index? Is it just as important for some stocks, as I guess is what I'm asking?
Yeah, probably. Right? Like those archy, growthy names are probably going to do well in an environment that bonds are rallying, right?
Listen, these charts, dollar and yields, were major headwinds in 21, 22, when most risk assets were falling. Dollar, yes, we've been pretty obnoxious about it. That headwind is at least removed for now, right back in the range. Now yields are following. And we should be talking about, both of them equally as much, because now both of those, what used to be major intermarket headwinds are really becoming tailwinds.
Yeah.
Stocks have been rallying without that really being the case the entire past 12 months.
So now I'm going to give you TLT and ARC here.
Yeah, that's what I'm talking about. Sure.
So here's TLT and ARC. Go to new slide 2 there, Spencer, and here's your TLT ARC ratio. So tell me what we should be looking for here.
They both go up together. That's what we should be looking for. ARC's been
bonds peaked first, right? And then it took ARC a little bit to figure that out. And then they both really started to collapse at the same time in early 2022. That's when the big break happened. They both completely collapsed.
Yeah. ARC started basing last year.
Yeah.
Started getting
as did a lot of semis and software and Chinese internet. Like that base that you see in ARC, you're seeing all over the market.
Yeah, man. Yes, they're everywhere. These massive bases, they're so good. Talking about them a lot.
Yeah.
Yeah, ARC and all them based and bonds haven't.
These reversals have not even completed yet.
Yeah.
We talk about how some stocks have made new all-time highs and look so good and completed their reversals a long time ago. I would go so far as to say, actually, I know we've done the math, particularly on the S&P 500. The majority of bases have not completed. The majority of stocks have not put in primary trend reversals, but they're coming. So what kind of a market are we looking at Q1, Q2 next year if all of these bases are just now completing now?
TLT is not the only bond proxy. Why don't you throw up a new slide 2 here? This is the 7 to 10 years. So this is more of the benchmark yield ETF. This is the IEF, which has been a great, very helpful, because for us, it was, if it's below 100, you stay away, keeps you out of trouble. Boy, did it keep us out of trouble.
This is the 10-year upside down. Yeah.
The 10-year This is the 10-year yield upside down. Correct.
Yeah. Basically. So just like the 10 is, like I'm saying, breaking back into that old range. Now this is bonds. If you wanted a vehicle to express a thesis on yields falling back into that old range, maybe you get some sort of like scoop and score squeezy move here in IEF. It's not for me.
And if you're going to get a squeezy move in IEF, why don't you go back to slide 5 there and remind people, if you're going to get a squeeze in bonds, how is that going to impact the stock market? Drum roll, please. It's probably not bad for stocks, Strazza.
Yeah, I wouldn't want to trade it through bonds, because the way I'm seeing yields right now, I think we have to be careful with the Fed. They're pricing in cuts in like Q1, which is really soon.
Who's they? Fed Fund Futures?
Yeah, market. And I feel like there's probably a.
What are you moaning about over there, Spencer?
No, I thought it was May. that they were.
It used to be. It was.
Oh,
Yeah.
it was. Oh,
See,
I
Fed
haven't
Fund
looked in them.
futures. Fed Fund futures trade every day.
Okay, they change. I get it. Here, I'm going to the
They
Fed Watch
change
tool.
every day during the day because it's an active market. But
Yeah.
They've changed since Strazza said. Right.
so just think about it, right? Say it is May and not Q1, then they have to reprice that. I think bonds could be a messy trade, but if yields are just done going up, then I think there's a ton of stuff in the stock market and risk assets that would be preferred vehicles if we're talking about the impact of the bond market.
I just want to mention. I want to mention one more thing here. Go to slide 8. I don't think that this is being talked about enough. I don't think it's being talked about enough. The Magnificent Seven. These serial killers who think only 7 stocks are going up.
I heard it's the Magnificent 8 now. Ooh, I got a point.
The German DAX.
Yeah,
Pushing up against new all-time highs, guys.
So
what are you laughing at?
No,
I'm not on the chat. Sorry.
What is this up to with the Magnificent Seven? You're confusing people. This is not included. This doesn't count.
That's what I'm saying.
Oh, I get it. Other things are doing well. All right, so listen. I was listening to our friends on the Compound and Friends. Are we gonna have Morgan House on? Because I think it'd be such a fun conversation.
Yes. We should.
I will say his voice kind of reminds me of Danny's, and I'm unsure how I feel about that.
That's hilarious.
That's hilarious. Podcast. He's on with Josh and Michael, and he's talking about things that never change, as you're probably familiar from the book. And he says, one thing that has always been the same is if you look at any 20-year period, the 10 largest stocks are going to change a lot. They never stay the same, right? They can't hold that leadership position. Michael pushed back a little bit. I think he's spot on. Maybe that's changing, because when did we start talking about FANG stocks? It's been 10 years already, maybe 8 years. These guys aren't just the biggest and holding their dominant positions. And you can point to Apple and Microsoft. Microsoft, the longest. These 2 companies that have been there for a really long time. They're big. They're getting bigger. I find it really hard to believe that we're here talking about stocks 10 years from now, and we're not talking about Microsoft, Apple, Amazon, Google as the biggest.
Bro, they would have told, dude, go talk to your father. Dude, go talk to some older folks. They would have. They were saying the same thing in the 90s. They were saying the same thing. I can't imagine a world without IBM being a leader. I can't imagine a world where ExxonMobil is not one of the biggest companies. Come on.
These companies are built different. They're not. We're not talking about Sears.
Oh, because those weren't built different then.
Steel. I don't know. I just so you wouldn't take the other side of that. You think 10 years from now, let's just say the 4 real big boys, Google, Amazon, Microsoft, Apple. Are they all in the top 10 years from now?
No.
Wow. That's a crazy call.
Is it?
Because they would have to fall a lot.
So for me to be right, one of those not being in the top 10 makes me right. Yeah, I'll take that.
Yes. I mean,
I'll take that.
Think of how they're going to have to lose at least 50% to be out of the top 10, because they're that far larger than everything.
Dude, there's going to be stocks in the top 10 that aren't even public yet, don't even exist, you never heard of. Come on,
SpaceX. SpaceX is going to IPO as one of the 10 largest companies in the world.
Are you guessing that, or is that actually like a thing?
Based on the numbers, that's what it's looking like. It's going to be.
What numbers?
They have numbers. They put out the revenue numbers.
Yeah, they just
revenues.
They're getting ready.
SpaceX just did a raise or something, or they issued shares.
Is SpaceX just taking people to space, or is it the one with the internet satellite
thing?
They
own Starlink, and that's like
got it. Okay. All right.
I'll spin that off, but it's really exciting stuff going on over there. This IPO is less than 12 months out, probably. So we'll know soon. My cat's being really bad, guys. I'll be right back.
All right. I didn't want to talk to Strazza anymore anyway, because we are incredibly fortunate today to have one of my favorite technicians in the world, Mr. Ari Wald. Can we bring in my friend, please?
We can do that.
Please. Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mr. Wald.
Hey, good morning, JC. What's up?
Dude, it is such a pleasure to chat with you. Can I just tell you that? Such a pleasure.
No, it's good to be on with you and Steve and everyone here. This is a great little thing you got going here. The morning
Thank
show.
you. Thank you. Ladies and gentlemen, if you don't know Mr. Ari Wald, your life has gone horribly wrong, apparently. But Ari Wald, one of the world's best technicians, in my humble opinion, chief strategist, right? Chief market technician at Oppenheimer. Do I have that right? Is that what they're calling you these days?
Yes, that sounds about right there. Not a big, the head of technical analysis there. I work with a lot of bottom up fundamentalists.
Listen, if you weren't the head of technical analysis and you had to answer to someone, that would be silly. That would be silly, right? Ari, talk to me, man. You do a lot of work. You put in the time, you do a lot of back testing, you question a lot of things. I appreciate that about you. By my work, the new 52-week lows list peaked in June of 2022. By the time the S&P and some of these other indexes made their lows in the fourth quarter last year, there were very few stocks still making new lows, right?
That was a real textbook bottom, wasn't it?
I mean, classic, man. You buy midterm elections. Everybody
lined up.
Right? Everybody tells you that, seasonality doesn't work and it's already priced in, and sure enough, it was not. And then, what happened? We get the best first 6 months of the year in history for the NASDAQ, great start to the year, seasonal correction in Q3. You buy in October and get yourself sober. You got the Dow up 3,000 points in a month, NASDAQ up 12%. I mean, why should anybody be surprised by any of this, Ari?
Yeah, it's followed the seasonal script pretty closely there, and any of that stuff is secondary for us. But when it does line up with what you're seeing in the charts and the breadth divergences, it makes it all the more compelling. And then that's what was priced in last year was the recessionary expectations, and so now the market got repriced this year. And you look back at history, how these bull cycles typically unfold. I mean, you had textbook mid-cycle correction from July into that October low point, capitulation at the more recent October low. I mean, had a lot of stocks start to break down there at the end, falling below the 200-day average. And I always find that's pretty telling, JC. You have these bearish signals to sell the market, and bears can't push it lower. And you snap back, and your kind of your failed breakdown, if you will, an indication of exhaustion, lack of conviction on behalf of bears. And for all these reasons, why we think the mid-cycle correction has run its course, and why this next leg of the bull cycle is developing and should carry markets higher into early 2024. We've made the case that the market is conservatively undervalued based on how these cycles typically unfold, based on both magnitude and duration, that we should be expecting new highs. And I think there's going to be important to watch the quality of it. I mean, we've kind of argued that the strength we've seen, it's been stronger than a bear market rally, but we haven't seen the broad-based breakaway either yet. Small caps still haven't had that definitive higher high. You haven't had a big expansion in net new highs or stocks above their 200-day. So what's this going to look like? Are we finally going to see that? And I think if we do, that extends the cycle's duration by another 1 to 2 quarters. Or if it's going to be, again, just continued, just small caps failing to get to those higher levels, that would be worrisome. But as it stands, I think new cycle highs are in the cards over the coming weeks to months.
Yeah, no question. I want to talk to you about sort of market breadth and participation, and this false narrative about only 7 stocks and weak market breadth. Can you talk about the difference between concentrated leadership versus widespread distribution, and how one doesn't necessarily equate to the other, right?
Mm-hmm.
And the fact that tech is doing well in a bull market when historically tech does well in bull markets, right? Can you talk a little bit about sector rotation and breadth and how you're looking at that?
Well, I'm glad you asked. I mean, I think we could spend our entire conversation on this matter and the intricacies, and there's a lot I want to hit on here. So let's start with kind of how you asked it and what we've been kind of keen on, the difference between narrow leadership and narrow participation. I'm okay with narrow leadership. When large caps outperform, mathematically speaking, there's going to be less market cap outperforming against that backdrop. And we've seen that before through bull market cycles as well, from 1983 to 1990, then again from 94 to 1999. It was large caps leading on the upside. Small caps were still participating. So that's going to be important that small caps do participate. And I think they are in position to do so. I think it's just as notable that they haven't broken down, and that's going to be important that continues. But I'm okay with large caps leading, especially when you think about the construction of these indexes. If we look back at every bull market cycle since the 1930s and just looked at whether each sector outperformed or didn't, and we found that technology outperformed in 20 out of 23 bull market cycles, 87% of the time. That's the best hit rate of any sector. So
what's the second best, out of curiosity? Industrials or discretionary or something?
I think one of the consumer durables, I believe, is up there. Financials, kind of mixed, 55-60% of the time. So tech and consumer are two of the higher hit rates. So in a bull market environment, we'd expect technology to outperform. It is outperforming, and accordingly, the benchmarks with the higher weighting to technology should be the leadership. And the S&P is benefiting from its double weighting to the sector versus
and then Q's up almost 50% for the year because of even more tech weighting, right?
Yeah. Oh, yeah. Yeah, that's exactly that. The larger the tech weight, the stronger the benchmark.
And then the Dow has the least amount of tech, so it's right?
Yeah, and it's having trouble. And then I heard Magnificent Seven and this idea that and forgetting about it, and I get it. And if you look at these markets on an equally weighted basis, they have been the returns haven't been as strong. They've been more subdued. They've kind of still in their bases. That's where the potential is going forward. But, I think it's funny that, bears are kind of framing the discussion. Well, I got it right. Look at the equal weighted market, this year. But I don't have their, I'm not checking receipts that closely. But I would guess coming into the year, if they were bearish, I bet you they were bearish because of the Big Seven or whatever it was. That they were probably making the case for stock selection, that the average stock is going to outperform the benchmark because of elevated valuations.
Because in the back half of the year, people forget that the back half of last year, stocks did so well. Stocks did really well in the back half of the year, except for the mega cap tech.
Right.
So they were bearish because of that. Then those stocks did the best.
And
those weren't doing well enough. Now they're doing too well. Like, it's always something, right?
It's always right. Exactly. They're trying to they're moving the goalposts. Even regardless to that, if you look back, what the outlier, and here's kind of what we've had a more differentiated take, and I'm sure we've discussed this before as well, and I always love to bring this up. If you look at really what the outlier is, it's not what those stocks are doing, it's what the rest of the market's doing. It's not that I've seen a lot of studies looking at the performance gap between those names and everything else, however you want to measure it. I saw one like kind of high dividend versus low dividends, biggest gap since the year 2000. And that's true. The gap is significant between those and everything else. But the driver of it, the outlier, it's not what the seven are doing. If you look at long-term rate of changes for the NASDAQ 100, it's been, we've made the case, it's been the steadiness has been underappreciated. Returns nowhere near the returns seen in the late 1990s. That instead, the outlier has been how weak the rest of the market's been. This has been an awful bull market. They've been right about that. And for all those reasons, why we think we see potential to the upside, that rather than if the big divergence there was driven by, then corrected by catch down post bubble year 2000, this time around, the driver, I think, is going to be catch up by these weak areas. So if getting back to the point you and Steve were talking about, if there's going to be different companies that are going to be on the leadership board 10 years from now, it's not that those big companies have to weaken. More likely, it's going to be some other companies catching up on the upside, which I'd love to see. As it stands, there's really no signs of that. To us, technology still exhibits the most attractive risk reward, and I think positioned to continue to lead markets higher, given the broadness of it. That it's not just those seven; it's strength across capitalization. We've kind of talking about the strength in small cap technology versus the benchmark across
small cap
software,
industrials are up 35% off the lows.
Semiconductors, yeah. And in some other sectors as well, industrials, pockets of financials. It's really been masked, right? It's been concentrated weakness in regional banks. That's masked strength, elsewhere, even in the small cap gauge. And now you have regional banks starting to lift higher, push above their 200-day. This is our case for a market surprise. That if you look at the KRE, the regional banking ETF, looks a lot like it did in 2020, where it just needed more time. You had a crash low. It jumped into the 200-day. Then it just needed to form a larger W. That's exactly what's played out this time around. If that could get going on the upside, given its weighting in the Russell gets going, and we finally have the long-awaited broad-based breakaway. And we've kind of noted that I think very few are positioned for that type of scenario where the market actually, the surprise scenario is on the upside. And so for all these reasons, we're positive going into 2024.
Ari, I got a good one for you. So when you look at the composition of these indexes, and for me, I like to reverse engineer what a bull market looks like and how the market's behaving if this is a bull market, right? Healthcare is 21% of the Dow Jones Industrial Average, right? It's the largest weighting in the Dow. It's the second largest weighting in the S&P 500, healthcare, after technology. If this is going to be a bull market, right? One would think you're going to get some kind of participation from healthcare. And when you look at positioning from a sentiment standpoint, we're at washout levels in healthcare positioning. Again, I think that some of that in the case of financial strength being masked by weakness in regional banks, you can make similar arguments by some of the areas in healthcare, like biotechnology has gotten killed in some of the other areas as well. But you're seeing segments of strength in healthcare, like you're seeing segments of strength in financials. Is this an area that we should be looking at, healthcare? Just like from, are you seeing any signs of that? Or is it just reverse engineering what a bull market looks like and that probably needs to participate? Like, how are you thinking about healthcare here?
Great question. And let me just lead in with this. If you were to look at all the sector relative ratios going back a century, there's two sectors that go from the lower left to the upper right that have just shown kind of long-term secular outperformance. One, technology. The second is healthcare. So it would make sense from that vantage point. At some point, healthcare, as poor as it's been in recent years, could finally turn around. Now, with that said, as you ask me about healthcare, I go through client meetings and I make the case you can't make a call on healthcare. What does that mean? All the pieces are different right now.
Yes.
That all the sub-industries are doing something different. Medical devices break down. The relative strength goes into providers and services. You got large cap pharma kind of trading as a high dividend bond proxy, low defensive, biotech more as a small cap growth beta trade.
Yep.
So you can't make a call on healthcare. You got to make a call on the parts because the parts are doing all something different.
That's fair.
So for me, we like providers and services. That shows the best relative strength. I getting a lot of questions on biotech, of course, because I've seen the chart that you've put out there, and it's
I like it down here, Ari. I like them.
Coming off a low point, very similar to 2020, 2018, and all those major. So this has been the low point of XBI over the last, let's call it 5+ years.
Yeah.
What I've noted about all those turning points, they were all accompanied by broader market rallies. So I think the case for that to work, I think you need to get the market call right. This has to be this point where participation broadens and these kind of low momentum laggard areas work as well. Because I guess on a relative basis, the relative trend hasn't been as strong for XBI. For us, we prefer relative strength, and I'd rather be in leadership areas, but not the time to be betting against those at the very least. I think in conjunction with my market view and a rising tide lifting all boats, this seems to be an inflection point for XBI as well.
How many people you talk to? Sorry, I know Spencer's got a question for you, but I got one more. Sorry, I always steal all the questions for our best guests.
That's okay.
And I'm okay with that. You talk to a lot of people, right? A lot of institutional investors. How many got financials as the leader next year?
Oh, I don't even get questions on financials, and you can't, you bring them up and they're just like, they nod their head. But
what does that suggest to you, Mr. Wald?
Yeah. I mean, it's a unloved sector. There's contrarian. It's definitely a contrarian call to be made there.
European financials are hitting new 52-week highs. Is that evidence of a crisis?
On the value side, right? The interest is in the high dividend. I think they want to buy because they're worried about macro. They want to buy the safety stuff that's beaten up. But what we've kind of argued that if you strip out technology from the equation, cyclical value looks stronger than even defensive value here, and why we would side you more towards, let's say, financials rather than a utilities or a consumer staple or something like that. So within financials, even forgetting about banks are just emerging, but there's actually some really nice strength going on there. Otherwise, private equity names breaking out to the upside.
Insurance.
Insurance has been
obviously
coming off new cycle highs.
Both U.S. and in Europe, these like Swiss insurers and French insurers are crushing it. And in the United States as well, the credit services companies, things like CBOE and some of these exchanges continue to do well.
It's been awesome, yeah.
Yep. So there's been pockets of strength there. It's specifically been the financials. Look at Berkshire Hathaway, might make a new all-time monthly closing high today, not too far away from it. It's the largest component of the XLF, right?
Oh, yeah. Yeah. The Visas and MasterCards of the world there. So there's definitely stuff working in that space. And now we just banks have, again, it's the weakness in banks that has masked that strength that, we do these momentum scores where we kind of aggregate leadership and there's a breadth element to it. And financials have a pretty low score. I think one of the bottom two of all sectors. If you were to take out banks, all of a sudden the sector's score is like a top two score. So it just goes to show how skewed that's been to the weakness in banks, which are now actually starting to pop their head up as well.
All right, so Ari, there's a lot to like here, right? What's your best or favorite year-end idea? As far as sector, technology.
Yeah, the thing with technology is that it's best of both worlds because you have the established leaders, and then there's rotation potential as well as you move down market cap, and you have some of these mid-cap growth software companies. There's the XLK. Do I have the software spider in there as well? So that's the leadership. That's worked. Cap weighted XLK. Stick with that.
I don't think we have the software.
Tech starting to move its head higher, and probably the best ideas, just getting even a little bit more specific, would be, I think it should be the next chart. It's the software and services spider. It's equally weighted. No stock has a weighting of more than 1%, so it de-emphasizes the big names. And to me, within tech, this is where you get your rotation potential as well. You got a lot of these names that are just coming out of year-long bases. They were starting to in the second quarter. They got pulled back by that Q3 correction. Now reclaiming breakout points, reclaiming their 200-day average, all while showing good relative strength through that setback. And to us, some of these names are really set up to.
Ari, there's so many charts that look like that XSW. Like, just go chart by chart, right? People who actually take the time to do that. There's so many that look exactly like that. Like, that is such a great representation of such a large segment of the market that started its basing process in Q2 of last year.
Yeah. There's exactly right. So they've been They were basing. Finally broke out in the second quarter. That was it. You got a smell of that broadening bull market. Didn't quite accelerate, but I think now we're gonna see again if we can get that acceleration going forward, and let's see what the quality of this move looks like.
Can we get back to sentiment quickly? Coming into the year, the geniuses over on the sell side, when you look at the Wall Street strategists, actually had the S&P falling, consensus falling this year for the first time this century. So they had the stock market falling. S&P's up over 20% this year. NASDAQ up over 46% this year. Dow 2% from all-time highs. They could not have been more wrong, right? And going into next year, I haven't aggregated it all yet. They're all these silly year-end forecasts are coming in, but I'm not seeing a lot of optimism.
And I think it just goes to show what such a big driver of these market moves are. Positioning at the end of the day is just really been top of the indicator list in recent years. There, amid all these concerns, just at the end of the day, I think positioning has been the key thing to watch. Recently, and it ran up a little bit, got a little frothy in the summer.
Yeah,
some volatility, and that's where you start to see where positioning's at. And I think what we saw there with bulls with one foot out the door, the bears are ready to come right back with their.
They were apologizing. These sell side analysts were like apologizing for being so wrong. The perma bear ETFs were shutting down. Like those were the kind of signs, heading into a seasonal weak period that was like, all right, feed the ducks, add some shorts,
And we finally capitulated in October. And then I think it's funny. It's, you're so many prognosticators are worried the market's too weak in October. Now it's too strong, right? It's like you're never happy when that's the case, when you can quickly go from worries about being too weak to now too strong.
That's when it's time to see a therapist, right? They have hotlines, 1-800 numbers you can call for this sort of depression, right? Like, if one of these people, right, help them, right? It's silly. You said twice you talked about sentiment capitulating in October. Why do you say, obviously in hindsight, right? But what is it about October's sentiment that you is there data behind that? Is it anecdotal? Is it a combination of both? What suggested it was capitulatory?
Oh, it was more, so I guess sentiment as a whole, it didn't get as pessimistic as it was in October a year prior.
Right.
It was kind of more bull market pessimism, as we were framing it, that we were saying we wouldn't expect it to get much lower, just given the bullish environment we're in. It's more so just looking at the charts. You had a lot of charts finally capitulate below their 200-day average. And so this brought in some sell signals. There were reasons to get worried there. So it was more the false breakdown that then you snap back. I was waiting for you to put in one of those oops kind of in your charts there.
There were a lot of those. You saw them in bank stock too.
You had a lot of oops there in late October that reversed. So it was more
like the oops.
Some breakdowns. There was reasons, signals for bears to really jump on the market there and punch it lower. A lot of stocks breaking down, and they weren't able to do it. So it was more the inability to do that, the lack of conviction on bears there at that point in late October.
Ari, next Wednesday, New York City, CMT event. I'll be sharing some charts. It's going to be open bar, so you should come.
Awesome. I'll look for you there. It's so tough these days. I used to love those events.
We used to go to all of them.
Everyone. Oh my God. I absolutely love them. Where's it going to be?
Stone Street.
Stone Street. That's like my backyard there too. Oppenheimer is right there.
Are you familiar with some of those establishments there on Stone Street, Ari?
No, well.
I most of us do. Ari, thank you, man. This was freaking awesome. I really appreciate this conversation.
We'll do it again soon.
Please. Care. Yeah.
Thanks a lot, Ari.
Appreciate it. Bye.
Ari Wald. He's the man.
I don't like picking favorites, but he's definitely. But if you were to tier them, Ari Wald is definitely in my top tier.
I pick favorites. Ari's one of my favorites. I always say that. He is one of my favorites.
Yeah, he's in tier one. Put it that way. He's in tier one.
If Spencer thinks you're good, how bad could you be? Right?
That doesn't mean anything.
What do you think, Strazza? Strazza's quiet there. He knows that.
No, my cat knocked over half of my books in my office. I had a
You have a strong cat, bro. What's he eating, the
I
cat?
don't know what's going on with her this morning, but it's not good. So I
She's not
missed
used
off.
to the. She's not. She misses the green, the key lime green walls. Is what she misses.
I think a lot of people will probably miss the green.
I got thrown up on this morning by an infant. So,
Is it the color of my old walls?
I was all white. He was drinking milk, drank too fast. My kid's an animal.
The color of my new walls.
This was a 5 a.m. at the Parets household is like.
What do you want to talk about?
Software. We'll save some of it for Sean, but we got a lot of software charts here. Cloud stocks, Rip City. We had Salesforce earnings after the close yesterday. We can talk about that.
Yeah, let's do that. Let's talk about these things so we can talk about the trade that we put on yesterday with Sean.
Yeah.
But so this is what Strazza says is the world's most important index.
Never said that.
I think you did say that.
No, he said semis.
It's one of them. Semis is the most important.
Said semis today. The other day it was software. Depends on how his cat's feeling, I guess.
These are the best stocks and probably the most owned stocks. That makes this index important. So it's
The most owned stocks.
yeah. Yep. The stats would back that up if you want to go find
I'm
that.
curious to see how you quantify the most owned.
I don't know if you've heard about this thing, about the way that these software stocks continue to grow through good economies and bad. You heard
I'm
about
into it. I'm long. I got no beef. I'm just asking like how you quantify most owned. Like I don't know what that means. Like I mean I get it. Probably a lot of people own it, but the most owned?
Probably not that hard. You just look at the AUM and then overlap of these big ETFs, and then you can infer a lot of things from that.
Think of some of the names in this. So if we just were to take it from the top: Microsoft, Oracle, Adobe, Salesforce, Intuit, ServiceNow, Palo Alto, Workday, CrowdStrike, Autodesk, Palantir. Yeah, these stocks are widely owned.
I want to talk about something. So Ari brought the ETF that we're talking about, how so many stocks and sectors look like that. The bottoming process that began in Q2 of last year. This is Exhibit A, right? You could see that consolidation beginning in Q2 last year. You had that final, like that low that couldn't hold in Q4, which we saw a lot of in technology and in growth, and then the ripper into the new year. But now what you're seeing prices exceeding those former highs from last summer, consolidating over the last several months, and now breaking out to new highs. So what that means to me is that there is precedent already set. So when you see one of these 1.5 year long bases that started in Q2 last year, which by the way, there are a ton of, there's already precedent set that an upside resolution would not only not be abnormal, would actually be perfectly in line with what we're seeing around the market, right, Strazza?
100%. And I
I'm preaching to the choir here.
Yeah. No, look, the best ones already cleared these ranges and are back above their summer highs.
This obviously software being one of them as an index, and the stocks, the components thereof that have done that as well, which we've talked about here plenty. But yes, bigger picture, there's precedent. So when you're looking around at some of the other ones that look like this, and you're wondering, which I often do, if they're going to break out or not, the higher probability bet is that they are going to break out.
And also, just a good lesson, this chart right here, where we have the second arc drawn, a lot of people were drawing this very differently, including ourselves, right? Asking if this was going to be a top, right? We had a red arc on this just a few weeks ago, and the index was making multi-month lows and looked to be completing a top. And you got this whipsaw move, nice shake higher, and we've been off to the races ever since. Straight line.
Yeah, 100%.
So
yeah.
Textbook not top. The textbook non-tops, right?
Yeah.
You want to talk about this coil in the Russell 2000?
Please.
Okay.
Well, what did you want to do, Spencer?
No,
Well, I thought we were talking software. We have more software charts.
All right.
No, but I do think that this is part of that big conversation. Show it, Strazza. I think this is important. This is a good call on Strazza.
It's the chart from the hot corner deck, Fonz. Chart 7 from the hot corner deck. We've gone sideways in most stocks since November 14th. Market internals peaked on November 14th. We had a nice spike in a lot of these new highs indicators. And while the best stocks and the best indexes, yes, have continued to just grind higher just at a slower rate than they were earlier this month, the average stock, and let's use the Russell 2000 to illustrate the average stock here, has gone straight sideways in a really nice coil. So I think if you're sitting here and you have tactical positions on, you're asking yourself, are we really going to rip into year end? And what does that look like? It's how this coil resolves, right? Because it's been 2 weeks of tight sideways coming off an automatic reaction low from late October. It's not the end of the world if this resolves lower at all, but it probably means further or deeper or more widespread corrective action for the next week or two than we saw for the last 2 weeks, right? Where some of those leaders do give back and you finally see some red candles. On the other hand, if this resolves higher, which I think it's about to here today, then it might be just, green light, party on into year end, I think.
Party on, Wayne.
Yeah, party on, Wayne. Yeah, sure.
That was before your time.
The way this
Definitely.
thing resolves is really important to how we finish the year, no?
I mean, I think that there's already, speaking of precedent, I think that there's already precedent in some of these where you're seeing the individual small cap sectors
banks
in industrials and
banks.
The
banks. Big move yesterday.
You're already seeing strength. So to think that this one's not going to break out, right? I think is a low probability bet, is it not?
Let's see it though, right? Like you can draw equal weight industrials, equal weight discretionary, all the same way. This little 2 week flag, and we kind of like started to go yesterday, then didn't have the best close, and it's looking like we're not going to get that downside follow through today. It's looking like instead they're going to give them another shot at breaking them out. And yeah, they probably go here today.
And Steve, what about micros? IWC holding on to 100, right?
Big level. Nobody talks about these stocks. Nobody talks about this index. It's such a great piece of information.
I feel like we talk about it every day.
Good.
No, we definitely don't.
Nobody else is. Happy to talk about it every day. Just like
we do talk about it more than anyone else, but we don't talk about it every day. Hey, wait. Let's go back to software. Let's go back to software here because how many times have we seen the beat or miss of an earnings, the quality of an earnings report tending to go in the direction of the trend, right? So Salesforce has been, of course, it's tech, so it's been having a hell of a year, and surprise, surprise, they had a great quarter, right? They beat across the board on their top line and their bottom line, on their earnings and their guidance. It was all good. The stock is up 8% this morning. And it's kind of leading the charge here for software.
This is Salesforce, you're saying?
This is Salesforce, yeah.
Didn't we have others like Autodesk?
We had so many. Well, we didn't even discuss Zscaler from the other day. I know Sean has a couple on his mind.
I don't know.
We had we've been talking about Cloudflare. There's a bunch. We have Datadog, Snowflake, 52-week highs. Yeah,
I'm all bulled up. I'm all bulled up on the dog.
Yeah, I mean, listen, when you see the index itself doing what it's doing, there are components driving it, right?
Okay. These software stocks that we're talking about right now, just the names that we just threw out, maybe not Salesforce, but these other ones, they're different. They're different from the software stocks that have been working. And I think this is where the big opportunities are today. Earlier this year, I would have told you stick to Adobe, stick to Microsoft, stick to the big boys, right? That's shifting. Throw up the ARC Internet Fund.
Snowflake up 7% today.
Yeah, that's another one. Look at that base. Hasn't completed yet. These things are just starting. They're just completing and finishing the sideways phase, ushering a new uptrend phase, right? So like you're getting these fresh. You can buy Microsoft. It's already hit a couple price targets this year, right? I think that's a harder trade now than buying these fresh base breakouts. They're everywhere. Show the relative trend. Not only are we seeing these reversal patterns on absolute terms, and we're used to seeing this, but the relative trends are reversing also, indicating that these stocks, or if you want to glean some information, throw up the ARKW relative trend, please. If you want to glean some information into the broader market, it's suggesting that the riskiest stocks, some of the longest duration equities, or some of the most offensive stocks, are now primed to outperform over the longest time frames. Is that bearish, JC? Could that ever be bearish? A primary trend reversal in some spec tech index like this?
Doesn't strike me as bearish.
I mean, would you agree that this is where you want to be fishing now? Fish for the fresh base breakouts, not the stale ones?
I believe this is one of the places to go fishing, Mr. Strazza.
I would be fishing here all day. Okay. There's some good stuff here. We just showed a couple of them. Can't give all the goodies away though.
I think that there are places to go fishing in. This is a very good one. I think it's you know, in a roundabout way, a similar point that Ari was making earlier, right?
Now, and this is not like a rhetorical question. This is a real, I think, something that we should give some thought. Would you rather buy the base that just broke out? Or would you rather buy the base that broke out in Q1 of this year and has already hit 1 or 2 price targets and is back to those old highs? And why? All things equal.
I think there's a case to be made for either, right? I don't think that there's a wrong answer. I think it depends on what the rest of your portfolio looks like and what you're trying to accomplish. I don't think that there's a one size fits all for everybody.
Throw up my triple pane chart of some of the most badass stocks of the year. So
The most badass.
yeah, it's been our strategy actually forever, for as long as I can remember, for as long as I've been here, to buy the best stocks in the best groups showing outperformance. This was very simple. These stocks started outperforming middle of last year, maybe in the case of Palantir, late last year.
Want to talk about somebody talking his book? This is like this is the most Strazza chart that I could possibly imagine. This chart is so Strazza. It's like
I know.
Right? It's just absurd how Strazza this chart is.
It's very clean, very clear. What I'm suggesting here is that, yeah, these stocks have
And I'm the obnoxious one.
These stocks have been showing leadership for over a year now, but with these primary trend reversals relative to the broader market, mind you, the best stocks in the broader market, with these relative trend reversals just completing right now, these things are poised for further outperformance, maybe an acceleration in that leadership over longer time frames. So I think the party's just getting started for some of these leaders. Very exciting stuff. I love these bases. What's your favorite? What's your favorite one?
I mean, I'm in the Uber, you know. So if we're gonna we talking our books here, you know.
The Uber.
I mean, you know, they're moving together. They're moving together. You know.
Probably gonna have some give back. I'll bet they sell the news when it gets added to the S&P 500, but that's fine. I don't know.
And when is that going to happen? Just like, is it imminent? Like they'll announce it on a Friday afternoon, hopefully people forget or something like that. One of those.
We should probably check, considering I'm holding like calls that expire.
You think it matters, dude? You think it matters?
It matters for me, right? Because
Why?
I'm at the point now. Well, I got theta not on my side in some of these positions, some of these kickers on here. I'm getting a little greedy with some of these calls I'm still holding.
But in this particular case, greed has been very profitable. It's the being gun shy that has cost people here, right?
Sean was so right yesterday. I think he said it on Spaces. I like pinged him, totally fishing for like some bearishness. I was looking for him to be like, yeah, dude, take profits. You're crazy. Sean was like, YOLO.
Haha. Listen, when Sean, who tends to be more conservative than you, is the one being more aggressive, like something's up.
Mm-hmm. Where is he? Does he want to talk to us?
He does.
I say we
He's
bring
here.
him
He's here. All
in. Bring
right.
him in.
Nobody.
Good
Johnny,
morning.
baby.
Hey, Strazza. I also, in addition to being your therapist, I also play the role of your vet. And I just want to let you know about your cat. The cat is probably reacting to the paint smell. Didn't you just paint your room? Cats have very sensitive noses.
She's losing her mind. She's running around the office just destroying things.
Here's what you need to know about cats, and you probably know this, but cats hate change.
Uh-huh.
And you've gone in and changed all the smells in the house. They're freaking out. She'll get over it, but
It's been
freaking
tough
out.
for my cats the past week emotionally. It's been tough on my cats. We were gone. We were in Miami, right? So we like left them in like a stink paint house.
Yeah. Cats are very self-sufficient, but they hate change.
Yeah. Yeah, they're rebelling a bit here.
All right. So what are we talking about? Software stocks,
I like
huh?
how the dude cats like don't even have to go hunting. They just sit back, and then the female cats go do all the hunting, and then they bring the food, and then the male comes in and be like, "All right, everybody out the way. Time for daddy to eat."
Dude,
That's kind of funny.
cats are savages. Like dogs are cute, nice animals. You should see like some of these little like lizards sneak into my house sometimes. The cats don't just kill the lizards, they torture them. They play with them till they die. It's like terrible. I'm like, what are you doing, Lola? Just finish it. And it's very strange. They're sickos, these cats. Yeah.
Sicko cats. Yeah, I know. I've had cats my whole life until now. Now I'm a dog person, but my whole life I had cats.
Hey, Sean,
Yeah.
how come you guys didn't like the Toll Brothers yesterday? My feelings were a little bit hurt after that meeting.
Because they were going to earnings.
Yeah. All right.
Somebody didn't like it.
Yeah, I do like it. But
crazy.
as JC said, we do have earnings coming up, but I like the other trade better that we put on. That's all. Can't they can't all be favorites, Strazza.
Which was net, correct?
Yes.
Yeah.
Cloudflare.
Nice follow through so far here today, it's looking like. And you know what the more important point about this chart is? All of its friends are breaking out. All of its friends who have the same looking chart pattern, they're going, right? They're going. So it's one of those situations where you make a list. If all your buddies who have the same pattern are breaking out from it, odds are favoring that you're going to break out too. And that's what I'm seeing when I look at this cloud.
If all your friends are doing it, you got to doing it too. Yeah, you got to be doing it too.
So here's the trade. So we talked. Ari was talking about this big base. Ari was talking about kind of like this software sort of situation on an equally weighted basis. We talked about how many charts out there look like this, where the bottoming process really got going in Q2 last year, and now you're seeing precedent where a lot of these are breaking out. So to bet that the ones that look like that are not going to break out is probably a hard trade. The easier trade, the higher probability outcome, I think, is betting that they're going to go higher. Sean, we were thinking something very aggressive, maybe a trade that we put on for maybe 4 to 6 weeks.
Yeah, I came into this trade with one mindset, and then as we talked it through, and well, I'll tell you what really threw me. But at first, I was like, all right, guys, I like this breakout. I think it's got chance for a pop, at least a run up and to and through 100. But you know, the fact that the broader markets and software stocks in general have all been screaming higher over the past 2 months, or not 2 months, month or so, gave me pause, as Strazza alluded to right before I came on, gave me pause that we could be due for a pullback, a well-deserved pullback, and certainly not a pullback that would break anything, but it would make it hard for any new bullish bets that I put on right now. So I wanted to be short term. That was my thinking coming into our meeting yesterday. But when I was looking through the options chain on Cloudflare, one thing that stuck out to me that just really caught my attention and it changed my thinking was I looked into further out options. Basically, if we look into next year, the furthest you can go out is June, and then after that you have to go all the way to January. So June, that's like 6 months out, right? 7 months out from now. I'm like, well, if I wanted to go longer term, what would I play? And June would be the month. And I looked at the June option series, and still, even today, I'm looking at it right now, the highest strike that the market makers are offering, the SIBO is offering, is 110. And I said to myself, wait a second, 110. Are we looking at the same? I mean, look, you guys have up here right now. The stock traded at 210, not that long ago, a year and a half ago, and we, at a minimum, we, based on our analysis, have a price target of 130 over the next 6 months. If the options market is saying, oh, there's no shot, that this thing's going there. I don't know. It just
Is this
it's
something?
like
Yeah.
it's like it's daring me. It's like it's daring me. Oh, come on, try that play. So I don't know. It made me think that no one's looking for it. No one thinks it can happen, and I like it when the stars align, when there's a trade on the table that the market is kind of ignoring. People are like, oh, this is not a thing. Well, those are the trades that end up being the biggest winners when we get them right.
So, Sean, this is almost a $30 billion stock. It's not like, a no-name, nothing company. Should have a pretty liquid options market. How unusual is that to not have strikes, way out of the money?
My only thinking on that could be, and I don't have this info, but it could be that they only just recently listed that June contract. Totally possible. And so sometimes when they do that, they just kind of sprinkle in a few strikes just to populate it, so to speak. But I'm looking at May, and May options also only go up to a 110 strike. And if I go to if I go to January 2025, it's more than a year from now. They're only listing a 110 strike next January. So I don't know.
So the market makers, the market participants, nobody is trading these any strike above 110. And Sean, you brought this up because you're like, you guys think that the stock goes to 130, but there aren't any 130 strikes at all.
Yeah.
I mean, I gotta take that as a positive, right?
I just, it's almost like the market's daring me to make that bet. Like, oh, you think it's going higher than 110? Okay, come on, we'll take your money. I feel like they're daring me, and I'm willing to play.
How are you feeling in general about volatility? With the volatility index down to 12 or whatever ridiculous number it is.
I had a conversation with one of our customers this morning in our customer chat that we have for All Star Options, and a guy was putting up some ideas about some different stocks. He wanted to sell some strangles and some delta neutral strangles.
You're not getting paid for it.
Well, that was my point. I mean, if anyone who's been paying attention to me over the last 6 months, they know that for a long time, up until recently, that's what I was doing, selling strangles, selling premium wherever I could sell it, because that was the type of market we were in. And I said to the guy, I said, look, you could put those trades on, but you're not getting paid for them. And one stock that he brought up, we won't mention the stock, but it was a high priced stock. And he's like, oh, but look at these options. They're so expensive. And I said to him, yeah, in dollar terms, they're expensive because it's a $700 stock. But in volatility terms, and I showed him the volatility chart, the volatility is as low as it's been in 3 years in this stock. This is a terrible candidate to be selling delta neutral premium. Doesn't mean it won't work. It could work. But if he's wrong, he's going to get whacked. And so, how am I feeling about volatility right now?
And you're not and if you're not even getting paid to take the risk of getting whacked, then why are you taking the risk of getting whacked?
Right. So selling premium in stocks right now, it's not high on my list of things I want to do. I'm sure there are pockets and opportunities in different places if you look for them, but generally speaking, it's not even something I'm looking for. I'm looking to do more aggressive bets, looking to get long, do it with defined risk in most cases. But yeah, I mean, this is an environment where you want to be playing for directional moves.
Listen, if Sean is more aggressive than Strazza and I, something's up. It's usually the opposite. Let's just check in on the markets quickly. Dow futures up 200 points. S&P futures are flat. NASDAQ futures down 50 points, about 30 basis points. Treasury bond futures on the 30-year down almost 1% right now. Gold down about 70 basis points. Silver flat, copper flat. Crude oil up over 1%. The dollar actually higher today, with yields higher as well. Bitcoin down 260 points, down to 37,600. I love how he's saying down to 37,600. Ethereum flat. Solana flat. Not much going on in the crypto space today. Actually, Polygon is up 7%, and the Doge up 2%, up towards $12 billion in market cap for the
Hey,
Doge.
hey, we got a comment that came in here, and I want to address it because I think it's topical right now. Elliot Wave Cafe said, "It's time to be cautious, Sean, not aggressive." And I know where he's coming from. He's coming from what I mentioned there early when I was saying I wanted to be short term in Cloudflare. Because we've had a big run already in a lot of stocks, yes, common sense, common wisdom, JC, is maybe now's the time to be cautious because we have a pullback coming. And he's not wrong, and I feel that. However, my stance is I'm going to position myself in trades with defined risk so that if I'm wrong, I don't get hurt. But if these trades do work, and they have been, look at Uber as a perfect example, these hard trades, they're going to pay very, very well. And that's been my attitude here. I certainly accept the fact that I have maybe buying right here today, I have a higher chance of losing, no doubt about it. But the wins, if they come, they'll be far more worth it.
And I couldn't agree more. The market is on melt up alert right now.
Right.
Like there's a big potential for just a major melt up into the end of the year. I told you guys this week, I've been looking at my watch list, looking at my morning chart saying, this is ridiculous. We have to pull back. I'm sitting here saying we did
though.
We corrected for 2 weeks since November 14th.
The new highs list peaked on November 14th. It is now November the 30th. Like, we've seen that.
Go look at the software index. Go look at tech.
I look every day.
They're steadily grinding higher, not lower. So it's a strange type of corrective action, right? I think that's like first level thinking. We have to pull back. Market's designed to fool the majority. It does a great job at that. We
Also
positioning.
Stocks move based on positioning. So these institutions that listen to these jerks on the sell side that told everybody to sell stocks coming into the year and actually listened to them, knowing how bad the sell side's track record is,
I don't know if anybody
they're on chase alert. They have to chase so that they don't look like such idiots. And that might seem stupid, and it is, but that's how humans behave, right? Yep. These are humans that are afraid to lose their jobs, not humans that are trying to do best by their clients. That's not how it works. They're trying not to lose their jobs so that they don't have to take little Timmy out of private school, right? And the wife needs a present and the country club fees. And this is an expensive lifestyle that these sell-side analysts and portfolio managers have put themselves in. So it's not in their best interest to do best by their clients. It's in their best interest to do what they have to do to keep their jobs. You see how this works? And if you don't understand how that works, it can be very confusing because it might not make any sense. If you understand how human beings behave when they're incentivized to behave in certain ways, it all makes a lot more sense.
And I love it. I love when people like to think that the stock market's rational. It's not rational. It's made up of humans who are all idiots.
Whoa, who are you calling an idiot?
No. It's not that they're not rational. They're not thinking rationally, right? They're thinking emotionally. They're thinking because of other incentives that they have, which is not always to do best by their clients. In fact, most of the times, it's actually better for them to hurt their audience and their clients. If you've ever watched one of these business TV channels, it's quite obvious they're not there to help you. It's malicious. They're there to sell sponsors to their.
They're there to entertain and inform.
Maliciously,
inform when they can.
In most cases.
Okay.
Notice how I stopped watching TV as soon as I started getting invited to be on TV.
It's not always malicious. Not always malicious. All right.
It almost always is malicious.
Can we talk some individual headlines here?
Finally. 10 minutes we're going to cover the news.
Yeah, right. So
the news is that the Dow is up 3,000 points in the last month. The news is that interest rates are making new lows, both in the United States and around the world. The news is that the German DAX is pushing up against new all-time highs. That is the news, Strazza.
The news has already been told by the price.
You're going to have some monster monthly sticks in your chart review.
I haven't peeked yet, but boy, am I excited.
I have.
You always
we were talking about healthcare services with Ari. Had a healthcare services bomb dropped yesterday, right? I think we have the chart. Humana and Cigna in talks to merge. God, how much consolidation has there been in this space? You had CVS and Aetna. Now you have Humana and Cigna apparently trying to get this thing done. UNH is, of course, a juggernaut unto itself. So yeah, this would be I don't think terms of the deal were made public, but it would be a cash and stock merger of some kind. So keep an eye on that. Both stocks went down yesterday on this headline. I'll watch them both today.
Cigna doesn't like this.
Neither of them like it. Last I checked.
100%. Yeah.
Humana too, sure. Okay.
Immunogen? You want to read the Immunogen?
Oh, that's right. We had a deal this morning. Freaking forgot. I forgot about that. Yeah. Where I gotta scroll to find it now. Oh my goodness. Where was it? There we go. AbbVie. AbbVie acquiring Immunogen, ticker IMGN. 31.26 a share in cash. So, I think we're trading at $28 right now. So $3 discount for that deal. But
so this is a hot corner name. You can throw up the chart. IMGN up huge here. Had multiple filings for this one. Came on our list for 2 different institutions since last year. Now you're getting the buyout. What's interesting about this one is, well, we're not going to go up the chart. While it does look really good with this massive candle here today, below its all-time highs still, from like 20 some odd years ago.
All right. Speaking of stocks getting taken out below all-time highs, there's been a growing number. We haven't talked about it at all, but there's been a growing number of companies that went public via SPAC getting taken private again. We had another one yesterday. Blackstone. Excuse me. Blackstone is buying Rover, the company that does it's like a dog walking app, and the takeout price is $11.
Let me get this straight. These companies did a SPAC so they can circumvent all the investor protection rules so that they can cheat the system and go public. And now they're going back private already?
Yes.
Yep.
This whole business is so dirty. I haven't liked it since day one. It smells dirty.
That's right. That's right. It's a beautiful thing. It's a beautiful thing, man.
ROVR is your ticker on that.
I want to talk about a dirty business. Can we hit it? I got a good one for you guys.
A couple more things. Tesla Cybertruck event, 3:00 Eastern time today. They're gonna start actually delivering these things, supposedly.
Are they gonna knock on my door? I ordered.
It's like the.
Did you order one?
What am I going to do with one of those things?
What's like the Westinghouse thing when they knock on your door and say you won? Anyway, and then Costco retail sales for November through.
Hold on.
Yeah,
it's a cyber truck. Does that mean that you can drive it in the metaverse?
I don't know if you can drive it in the real world.
You could drive anything in the metaverse.
I've seen some videos.
Anything you want, you could do it in the metaverse. It's wild.
AC will have one in Decentraland.
Yes.
Yeah, thank you. Publishers Clearinghouse. Thank you, chat. I want to say Westinghouse. Publishers Clearinghouse.
I'll take a quick question from the chat. Pharaoh Tower. Should I buy more Disney? No.
No.
Hey, Disney got 2 new directors yesterday. One of them.
I'm going to Disney next week, so the way my wife spends, that's going to help the bottom line.
Are they giving seats to who is it? Elliot? Elliot's getting seats. Is that what it is?
I don't know if this is a result of it. It's probably.
I like how Elon Musk told Bob Iger to go fuck himself. That was funny,
dude. On TV, no less.
That was funny. I like that.
TV. It's one thing to say it on the internet, but on TV, the FCC watches that thing. Anyway,
that was funny. Shout out Elon Musk.
Costco retail sales through the 26th up 5% year over year. So people
is Elon Musk? Is there anyone who epitomizes the phrase "fuck you, money" more than Elon Musk? I don't think there is anybody out there.
God bless. You know what's funny is what's that crazy lady over there in California? What's her name? Kara Swisher or something?
Kara Swisher.
What is that lady?
Why is she crazy? Why is she crazy?
Angrier lady? The Massachusetts senator or her? Which one's more angry?
Warren, yeah.
Elizabeth
I think
Warren.
Kara Swisher's not angry. Kara Swisher's just over it. She's just over it. She's been around.
What?
No, I'm over her. She's been terrible forever.
What are these women so angry about? Like, cheer up, lady. Like,
Breaking news: Kara Swisher is going to be the guest on Stock Market TV on Monday.
Hey,
Over my dead body.
Yeah, are you kidding me? We have smart people as guests.
Oh, come on. You guys are just hate.
Oh,
all right.
God.
Anyway.
Dude, that lady
and then
very angry.
With Elon
oh
Musk.
my goodness. I'm sure she's happy in her personal life.
Can we talk?
And then,
Hit the I'm sure she loves her kids. Can you hit the
There it
bumper?
is.
Because I got a crazy California lady story.
Fine. Gosh, damn.
So I'm ordering glass bottles for we're bottling our 2021 Cabernet Sauvignon, right? Get this. So my whole plan all along is for all the wines that we're making, we're bottling it, and the labels are going to be designed as an homage to the part of the world in which the wine was inspired from. So our Southern Rhone blend will be, very gaudy, Chateauneuf-du-Pape style, like glass, like just super gaudy as an homage to that part of the world, because that's how they do their bottlings, and that's what inspired the wine. So we're doing our Napa Valley Cabernet Sauvignon 21 vintage Calistoga. This is a shameless Napa Valley Cabernet, bold, high tannin, high alcohol, high acid, like just through and through, it's what it is. So we're going to bottle it with a traditional Napa Valley bold Cabernet, heavy bottling, heavy package, right? That's just my plan all along, right? And it's a dictatorship.
Okay.
I own the winery. So I'm on the line with the glass lady. So apparently there's this whole movement going on right now being led by some crazy lady over there against heavy bottling, right? So I am being warned by multiple people how this crazy lady is going to come after me for ordering these large bottlings, right? And they're going on and on and on, these glass people, about, this whole movement. And I'm just chuckling, and they're like, so what do you think, JC? And I'm like, you said that there was an even heavier one? Let's go with that one, right?
I don't understand.
I'm like, you understand that, like, I deal with, like, in my day job, I deal with, like, real, like, problems, right? Like, with real crazy people. This wild lady in California is going to have a problem with the way I bottle my wine. I dare you to come after me. Please.
Wait, is this one of those like esoteric wine industry things that like?
What's the problem with glass?
I think it's because of like these heavy bottles are like bad for the environment or something like that. Like it's not like sustainable, and like this lady has too much time on her hands or something like that. But I just found the whole thing.
When we're all going up to Napa later next year, can you schedule that meeting for when we're all there? Because I'd like to be a fly on the wall for that one.
The crazy lady, I'm not going to meet with her, man.
We'll get Giancarlo to film it. It'll be great.
Dude, it's like this whole thing, and my glass people are going on and on and on about how she's going to come after me, and she, they have their obligation to warn their customers. I'm like, stop. Give me the heaviest glass.
Oh, I see. I see. Okay, apparently 40% of the carbon footprint of the bottle of wine comes from the glass. Well, obviously it's made of glass, so that would make sense. So yeah, it's a heavier carbon footprint. I think that's the argument there. So, hey, it's your winery. Do what you want.
Yeah, of course I'm going to do what I want. Are you kidding me? I've been waiting 3 years.
Yeah.
I don't know how you survived living in California.
Just do wine boxes. That's what.
How did I survive in living in California? What do you mean?
Yeah, I don't know.
He drank his product.
Yeah, I guess.
I didn't have product yet. What do you mean? I still don't drink my product.
Where JC lived is different from the California that we like to joke about, I think.
Oh, yeah. It's actually, they're actually crazy on the other side, right? In the cities, they're crazy liberals. In the country, they're crazy conspiracy theorists, rights. Yeah. Like, it's like
you
polar opposites.
Yeah.
All right, my recess is rest in peace to a couple things today. First, rest in peace to the meme ETF. Ticker is meme, MEME. This is from Round Hill. They're shutting down after a couple years.
Is
So,
Round Hill shutting down or just their ETF?
No, just a meme. So you can't trade meme anymore.
How many ETFs can you fail before the asset manager shuts down, though? How many failed ETFs?
It's probably a firm-wide AUM question, right? So as long as they have one that's doing it right?
That's usually the way it is. They got like their big flagship or a second
Right.
one, and then the rest lose money.
Anyway, top holdings in meme are Affirm, Coinbase, GameStop, Mara, Riot, Spirit Airlines. What? Okay. Palo Alto, Roku, Robinhood. There you go. And also, rest in peace to the very first financial blog that I ever discovered on my own, the Reform Broker.
Yeah.
I saw this post this morning that Josh Brown, who you guys know better than me, is shutting down the blog. He's doing a new thing on Substack, but the Reform Broker, which
he has a new blog. Then.
Yeah, he's a new blog, but
it's going to be a new blog. He's going to do it through the firm because he says he's not the Reform Broker anymore, which he's not. And I remember when I remember the bar we were at. It was just him and I having a drink, and he's like, "I'm starting a blog. It's going to be called the Reform Broker." His original plan was actually to have me and a few others like contribute to the blog. It was going to be like a house of contributors. And then that never happened ever. Yeah. But that was the original, that was part of his original thesis. Like, I'm going to write, there was only like 5 blogs at the time. Like, I'm going to write, and then a couple of my friends are going to write. And I was like, yeah, whatever you want, Josh,
Like
and, except one that actually survived. Josh, when he remembers telling me that 15 years ago, I'll never forget it. I really remember exactly where we were sitting. I don't think any of us knew what the next 15 years would have in store for us, but it's definitely been a hell of a ride. We've gone different paths, him and I. I'm proud of him. I really am.
Yeah.
I really
anyway, I'm very nostalgic for this blog. It's like I said, it's the first financial blog I ever discovered on my own, and didn't have like someone show me. And so I've reading it for a long time. Not as long as it's been around, but as long as I've been paying attention.
I wonder if he's trying to get away from Reform Broker. Like, is he going to change his Twitter handle and all that stuff too, you think?
Well, he hasn't been on Twitter. He changed his Twitter handle a long time ago already.
Yeah.
He introduced him as like the Reform Broker on CNBC. So,
yeah. I don't know. Anyway, I just read Josh's first book just over the summer. So,
Backstage Wall Street. It's a good one.
Backstage Wall Street, yeah. Anyway, that's what we got. Okay, that's our show for the day. Unless you guys have any more recess to cover.
Chart request live, 1:00.
We could do this all day. I remember when Josh told me his wife was pregnant with his daughter. I'm like, you're fucked. I remember like he was like looking at me. He was like smoking a cigarette. He was like, what am I going to do? I'm like, I don't know. What are you going to do? That was before the blog.
Okay. All right. CRL 1:00 with Strazza and Pat. Options jam session just before that. It was Sean at noon. So that's what we got coming
up. Going to be a hot one.
Hot
one today.
Stock Market TV throughout the day. Thanks to Ari for hanging out. Thanks to all of you for hanging out. Go make some money. Apparently, it's a bull market party. And see you guys later.
Where's Strazza's bull market shirts these days? What's that all about?
Tomorrow.
The cat tore him up.
That's what happened. All right.
Bye.
I can't take no